Hello, everyone, and a warm welcome to today's Hauska Alumni webinar about NFT bubbles. This webinar is part of an event series that we conduct currently all around the topics of Web3, like NFT, blockchain, artificial intelligence, and the metaverse. I'm very happy to announce to you Andrea. He will introduce himself in a minute. This webinar will be recorded, and we will provide you with the slides of Andrea afterwards. I wish you a good session. You can ask your questions in the comment field. We will get back to them in our Q&A session, and then I'll hand over to Andrea, and I'm looking forward to your presentation.
All right, thank you very much for the introduction. My name is Andrea Barbon, and I'm Assistant Professor of Financial Technology at the University of St. Gallen. So in particular, I teach a financial technology course, also mathematics for finance for PhD students. So recently, I've been working, my research revolves around issues related to blockchain and crypto assets. So for instance, I have a paper on decentralized exchanges like Uniswap for cryptocurrencies. And right now I'm working on a paper about bubbles in the NFT market. So before going into that, let me try to share my screen and let's start discussing what an NFT actually is. All right, so let me try to find my slides here. There you go. All right, so I hope you can see my slides.
Yes.
That's just the title. Okay, so I'm not sure if everybody here is familiar with blockchain and NFTs. So I will actually take blockchain as granted. So as we hopefully all know, that's distributed ledger technology. So it means that it's a distributed or decentralized system that allows to store data, and in particular transactions data. And it's very secure, so it is immutable in the sense that nobody can change past transactions. And also it's basically almost impossible to cheat. There are different kinds of blockchains. So we have Bitcoin, for instance, where you basically can only transfer Bitcoin units among users. And then you have more advanced blockchains like Ethereum, for instance, where you also have the possibility to have smart contracts. Okay, so you can do more complex things. And one of the cool things you can do with smart contracts is that you can use them to define a token. Okay, so a specific token on the blockchain that can be traded among users. An evolution of this concept is that of non-fungible tokens. So those are tokens which are unique, meaning that every unit of the tokens is actually different from any other units. So think about Bitcoin, okay? You can also think of Bitcoin as a token, and every unit of Bitcoin is the same. There is no difference between Bitcoin A and Bitcoin B, right? If you get one Bitcoin, it's one Bitcoin. While for NFTs, for non-fungible tokens, non-fungibility exactly means that every token is different from any other one. Okay, so basically each token has a unique identifier attached to it. And these NFT tokens became quite famous, right? And people have been highly interested in them, mostly because people can attach them to different media. So think about an image, a video, a soundtrack, and this allows these forms of digital art to be traded in a market. So people are not actually directly trading the picture or the soundtrack, but rather, they are trading the NFT token, which is linked to this digital asset. Okay, so that's very interesting because it creates a market that couldn't exist before, right? Because the problem with selling a digital file is that this file can be copied and pasted and replicated an infinite number of times. And of course, that makes it difficult to sell those assets for a value, right? Well, with NFTs, the thing is that ownership is certified on the blockchain, and an NFT cannot be duplicated, right? So if you buy an NFT representing an artwork, you may show the world that you are actually the unique owner of that artwork. Okay, so this creates the basics, the requirements for an asset market to develop. Okay, so now let's quickly dive into some technicalities, and then we will move to the more interesting stuff. So, okay, so let me advance with these slides, and let me tell you about the ERC20 standard. Okay, so this is a smart contract standard or template, if you want, that allows people to create tokens, so fungible tokens, okay, on the Ethereum blockchain or any other blockchain supporting smart contracts. So those kind of contracts are mostly used to create so-called altcoins or utility tokens for ICO or for crypto-related projects. So the ERC20 smart contract actually requires the implementation of some functions, okay, that need to be there in the smart contract. So for instance, you have the function total supply that will tell you how many units of the tokens are available in circulations. Then you have the function balance of, okay, and when you call this function, you also need to pass an argument, in particular the address of a wallet, and this function will respond with the amount of tokens held by this wallet. Then you have the transfer and transfer from functions that allow you to actually transfer your tokens to somebody else and approve allowance. Okay, let's not dive into that. Okay, also the point of having this ERC20 standard is that anybody can use it to create a token, and then wallet providers or exchanges can efficiently integrate these new tokens into their systems, right? Because they follow this ERC20 standard. Okay, so if these exchanges know that if they want to transfer the token, they just need to call the transfer function, and as long as those are ERC20 token, the function will work in the same way. Now, NFTs, non-fungible tokens, are based on a different standard. So that's the ERC 721 standard, and it's kind of an extension or evolution, if you want, of the ERC20 standard, okay, which is used for the creation of non-fungible tokens. So it also requires to implement a set of functions which are very similar to the ERC21. So you still have the total supply that will tell you how many NFTs of that kind or of that collection, if you want, are available. And then instead of the balance of function, you have the owner of function. Okay, so here, instead of passing in the address of a wallet, you actually pass in the token ID of a specific NFT. Okay, so if I want to know for the Bored Ape collection, who owns NFT number 150, I just call this function with 150 as an argument, and it will respond with the address of the owner of the NFT, okay? And then you also have the transfer function, and in this case, whenever you use it, you don't only specify who is the sender and who is the receiver, but you also need to specify the token ID that you want to transfer. Okay, so this works very similar to an ERC20 contract, but it's just slightly different so that it allows for non-fungible tokens. All right, so now that we kind of know what an NFT is, hopefully, and then I will go on with some more practical examples. But let's have a look at the NFT market and how it is evolving over time. So right now, according to some estimates, the entire NFT market is worth about $22 billion. Okay, some people actually say that it's larger than that. And so the industry has grown, let's say, more than 200 times since the beginning of 2021. And in that year, in 2021, actually the amount of volumes or sales in the NFT market amounted to about $25 billion. Okay, and some projections claim that by 2025, the entire value of NFTs will be $80 billion. So, you know, I found these statistics on a website, and if you look at other websites, there are other statistics. So, you know, it's everybody is saying whatever they want about this. But because NFTs are recorded on a blockchain, we can actually look at on-chain data. Okay, so now let me share my other screen here. Okay, so I hope you see my browser now. And if you go to Dune Analytics, which is a website where you can actually track statistics about assets and activity on blockchains, you can browse this very interesting dashboard, which is called Ethereum NFT Market Overview. Okay, so here you have a bunch of statistics like volume by different exchanges, or the number of traders for different NFT exchanges. Then you have the top NFT collections ranked by volume. Okay, so you can see that apparently the most famous one is the Bored Ape Yacht Club collection, and the floor price is 50 Ethereum. So if you want to buy one of those Bored Apes, you need to pay at least 50 Ethereum. And the all-time volume is above, I mean, it's almost $3 billion. Okay, and then you can check these statistics for all the other very important collections like the CryptoPunks or the Azuki collection, etc. But if you scroll down, there are some interesting statistics about the trading volume on NFTs. Okay, so let's focus for a moment on this weekly volume chart. Okay, so first of all, this is split by exchanges. So in blue, you see OpenSea, that for a long time has been the prevalent, the dominant exchange for NFTs. Okay, so you can see it in blue here. And you can see that in February 2022 and later in 2022, there were big spikes in trading volume. Okay, so this may indicate some kind of bubbling behavior in this market. And you can also see that after this big peak, the volume went down, okay, to much lower level. And interestingly, recently, the volume picked up again, okay? So you can see that after the beginning of 2023, the weekly volume went up, okay? And now there is this new exchange, Blur, which is attracting a lot of volume and actually took the leadership in place of OpenSea. All right, so if you're interested, just check for these NFT dashboards, and you have many other statistics here. And all of this data is coming directly from the blockchain. Okay, so we can observe on-chain transactions NFT, and this is, what they look like. So I see that we have some messages on the chat. Should I have a look at that?
We can come to them also later, I think.
Okay. So, I mean, a person is asking me for the source of these figures about NFTs in the slides, and I can provide it for sure. But I will say that looking at on-chain data is much more reliable, and it's a better source of information. So I would totally encourage you to go to duneanalytics.com and look at these kind of dashboards. All right. So now, before I go back to my slides, I would like to show you these NFT markets, okay? So this one is OpenSea, which for a long time has been the dominant one, and I'm very familiar with this market here. And the other one, Blur, the new one, is this one, okay? So today, I'm actually not showing you this Blur market. Let me stick with OpenSea because I'm more familiar with that. But what I wanted you to notice is that in both markets, the same assets are available. Okay, so you have these DeGods, for instance, which are pretty famous at the moment. And then you have the Bored Ape Yacht Club. And the same goes for OpenSea. Okay, if you go here on top, you have DeGods, you got the Bored Ape Yacht Club. Because the important thing to understand is that whenever we are trading NFTs on an exchange like OpenSea or Blur, we're not only interacting with these exchanges. We're actually using the exchange as an intermediate to actually perform transactions on the blockchain. Okay, so as long as an NFT is on the blockchain, you can buy and sell it from any compatible exchange. Okay, so OpenSea and Blur actually offer access to the same assets. Okay, so here in OpenSea, apart from this banner in the beginning, okay, which is an NFT drop by Nike, okay, so it's apparently on a set of very weird colored shoes by Nike. We can have a look afterwards. But you can see the list of top NFTs by volume, I think. So that's in the last hour. You can go all time, okay? And then you can see what are the most important collections of NFTs by trading volume. And you can also filter by blockchain. So now we're looking at all possible blockchains together, but we could focus on Ethereum, okay? And by the way, the biggest chunk of NFT trading activity actually happens on Ethereum. So you can see that Ethereum or all chains actually look alike, okay? But you could also look at LFTs on Polygon, for instance, and then you would have a different set of performing NFTs. For instance, the NFTs launched by Donald Trump, the Trump digital trading cards, is on Polygon, is trading on Polygon. Okay, so now just to have fun, maybe we can actually have a look at this collection by Trump in order to understand what a collection is. Okay, so a collection is a set of NFTs which are based on the same contract, okay, and are usually related to the same topic, and they are produced by the same artist, if we are talking about some visual art NFTs. In the case of Trump, okay, those are collectible NFTs if you want. But yeah, still, I mean, there is a designer who made images for all of those NFTs. Okay, so here you have some information about the collection. So you can see that it was created in December last year. Okay, and the total supply is 45,000 items. Okay, so this is the number of unique pieces in this NFT collection. Then, okay, there is a description. Here is the total volume. Okay, so this was 13K Ethereum being traded on this collection, and the floor price, so the lowest possible price you have to pay in order to get one of those, is actually 12 cents of Ethers at the moment. Okay, and here you have a list of items. Okay, so you can filter them by status. So for instance, you want to just look at those which are listed for sales that you can actually buy directly. Okay, and then, you know, there are a bunch of attributes that you can choose. Maybe you want the background to be a sunset, and then the exchange will show you only those NFT with the sunset on the background. Okay, so if I click on one of those, okay, so here I will see the token ID of the NFT. Okay, so that's the 25,490. And actually, this is also in the address here. Okay, so this is the token ID, and what comes before that instead is the address of the smart contract representing these NFTs. So if I want to buy one of those, I need to click on this button. But before I do that, I need to make sure that my wallet is connected. Okay, so in this case, I'm using MetaMask here. Okay, and my wallet is connected to the trading platform, the OpenSea platform, as you can see here. So if I wanted to do it, I could actually buy one of those NFTs at the moment. Now, if you want to see the smart contract, which is actually backing these NFTs, I think we can click on this button here, okay, from the collection page. And this will bring us to a blockchain explorer. So in this case, it's the Polygon scan. Okay, it's the Polygon blockchain explorer. And we can check the smart contract by. So here are all the transactions involving that smart contract. If I click on contract here, I can actually see the source code. Okay, it's actually spread out across multiple files. But interestingly, if I go to read contract, I can get access to some of the public functions. Okay, so for instance, I can check the owner of function. Okay, so just to try it, let me copy my address. Oh, sorry, that's the owner of function, right? So I need to put in a token ID. So let's go back here. Let's say that we were looking at this one, I think. Okay, so that's the token ID of this one. So I can go here on the Blockchain Explorer and ask the smart contract who is actually owning this NFT, okay? And it's gonna give me the address of this guy. So that's the wallet that owns the NFT, okay? And the exchange, by calling this function, is able to tell me that this NFT is owned by DeFi Brian, okay? Which is the guy holding that wallet address. If I click on it, I can actually see the other NFTs held by this account. Okay, so you can see that on the blockchain, everything is very transparent and information about ownership of NFTs is private. All right, so this is mostly what I wanted to say about the NFT market and different collections. So, you know, just to have a feeling of how it works, let's look at a different collection. Okay, so this among the very famous ones. So you have the Bored Ape Yacht Club, and you see we have a different page. There is a different smart contract in this guy. In this case, that's on Ethereum. Okay. These NFTs are more scarce, right? Because there are only about 10,000 of them around. And also the floor price is much higher. Okay, so that's 51 ethers instead of a fraction of an ether. Okay, so those are more famous NFTs, let's say. You can also check the activity from the exchange, actually. Okay, so here you can see how the price evolves over time, what is the trading volume, and what are the latest transactions. So for instance, 2 hours ago, this Bored Ape was bought for 54 ethers, which is about $100,000 at the moment. All right, so maybe that's a good point to stop for a second and ask you if you have questions about things I was talking about.
It is one question in the chat. You might want to have a look at that. First from Madam.
Yes, so I'm reading it. Okay, so basically, what are typically behind the top collections at this point? Are there examples of top collections which involve physical assets? What are the trends here? Okay, so I will say that right now we have basically 3 kinds of collections that are performing very well. So the first kind is art collections. Okay, so you just have some artists producing digital arts, and they sell this art in forms of NFTs. And you know, some of these artists are pretty famous, and their NFTs are sold for huge valuations. Then we have collectible NFTs, as in the case of the Donald Trump collection. Okay, and finally we have, or the Bored Apes. I mean, that also is in that category. And finally, we have another category of NFTs, which is pretty interesting, which is related to gaming. Okay, so basically, people playing a specific online game, they can also buy NFTs that are available in the game, meaning that if you own the NFT, then you can unlock some special features in the game. And then, of course, you can trade these digital assets across other users. So another question is, what is the point of collecting the Trump card NFTs? Hoping someone will pay more to buy it from me if Trump is re-elected? Well, so I think in this case, that's exactly the point, right? So I guess most of the people trading those Trump NFTs and also NFTs from many other collections are just there to, you know, speculate, or they see it as an investment. And they hope that they are early and they can buy these NFTs at a relatively low price. And in the future, the price will rise and they will make money from selling those NFTs. So I actually made a collection myself, okay? And this is a collection of art NFTs with images of famous fractal, the Mandelbrot set. And many people actually bought my NFTs, and initially those were sold at a pretty low price, but then in the secondary market, the price rose significantly over the course of, you know, a few days. And actually, I got to talk to many of the people who bought and sold my NFTs. And, you know, just a few of them claimed that they were there because they like the art. They are very passionate about fractals and they really wanted to own an NFT about fractals. But most of the people actually clearly admitted that they were there just to trying to make money, right? So they saw this upward trend in the price and they were trying to follow the trend and to make money. Okay, in the case of Trump, actually, it may be that some people are supporters of Trump, so they believe in his political ideas and his political movement, and they actually want to finance his political movement. And to do that, they bought a Trump NFT. That's also a possibility, right? Okay, so yeah, there is a collection of physical assets, okay, from Nike. So thanks, Sandro, for posting the link. Also, are there cards that are linked to real life actions? Well, I'm not aware of this, so that's possible. I think it will happen in the future, but at the moment, I'm not aware of any famous collection that is strictly related to real world events. Okay, and then there's a question on token-gated commerce. Honestly, I don't know about it. And in the interest of time, I will actually move back to my slides, okay, to continue the presentation, because that was meant just to be a short introduction on NFT markets. But now I would like to talk about my research on NFT bubbles. Okay. So in a nutshell, in this research paper, we identify 1,000 so-called price run-up events in the NFT market. Okay. So by that, I mean an event where the price of a collection rises sharply over a short period of time. Okay. And we see that such a sharp price increase actually makes the probability of a subsequent crash in the price much higher. Okay, and we will try to use some market-wide characteristics of those NFT collections in order to predict whether the price will crash or not in the future. And on top of that, we will also use blockchain data to find out if any agent-related variables will be helpful in the forecast. So more about that in a few minutes. Okay, we also identify a group of sophisticated agents that can consistently profit from those price run-ups. Okay, so basically they are able to buy the NFT at the right time and then they resell it maybe a few hours later when the price is higher, and they actually make money consistently across different events. So, you know, there are some smart speculators that are actually able to make money out of this. All right, so the data is based on a set of 1,000 collections traded on OpenSea. The data comes from OpenSea, actually. Okay, so the sample is from January 2021 to September 2022. So that was a period in which the NFT activity was very, very high. So we have 15 million transactions, 1.3 million unique wallets, okay, buying and selling these NFTs. The trading volume is about 20 billion in USD terms. And the average price of an NFT was about $2,000. In our sample. All right, so let's define a price run-up in a more precise way. So basically, it's an event where the average sale price of an NFT collection increased by 100% or more over the previous 24 hours. Okay, so it's a doubling of the price within 24 hours. We also required a minimum amount of trading volume, you know, just to exclude very small collections. So basically, we base our definition on a different paper, Greenwood et al. They have a paper called Bubbles for Fama. But, you know, we are doing a different thing because we look at NFT collections while they're doing it, they are looking at US industry portfolios. And because of that, we use a much higher frequency. Okay, so we look at price movement at the hourly frequency, hour by hour, while they look at returns at the monthly frequency. Okay, so basically they have a window of 24. So we have a window of 24 hours. So we require this price run up to happen within 1 day, while in this other paper, they have a 2 years window. All right, so let's look at the identified events, how they spread out over time. Okay, we have basically 1,000 events. Okay, so those are non-overlapping. meaning that if we identify a run-up event for a collection on a given day, I mean, so that's going to exclude that day for the other events. And as you can see, they are kind of evenly distributed across the sample. Okay, it's not that price and up events just happen within one specific month, okay, one specific week. The average number of people participating, so buying, selling NFTs within these events is 1,300. And the average trading volume per event is 1.5 million USD. Okay, so when we talk about events, we are actually considering a window of 2 days. So we have the 24 hours in which the price run-up occurred, and then we look at the following 24 hours. Okay, so that's a plot in event time. So t equals 0 here is the day, the hour in which the price run-up is identified in the data. Okay, and so here we are plotting the average returns on this event. So of course, those are highly positive in the first 24 hours, because by definition, right, we require a price run up, so at least plus 1%, and then we see what happens afterwards. Okay, and you can see that on average, they lose some value, but still, I mean, the price stays at a relatively high figure. But if we plot the median in light blue, we can see that it's much lower. Okay, so probably there are some events with, that are sitting on the right tail of the distribution, so they produce very high returns after the price run-ups, while many other ones actually perform very badly after the run-up. Okay, so the mean is bigger than the median, so this means that returns are highly skewed. All right, so having a look at the questions again. So now let's define a crash event, okay? So we say there is a crash if the ex post return is lower than 40% in the following 24 hours, okay? So if after the price run up, then we have a drop of at least 40%, we say that was a crash, okay? There was the run up followed by a crash. So if we take the sample of events, of those 1,000 events, and we split it into crashes and non-crashes, this is what we find when we plot the average returns. Okay, so basically, you can see that, well, first of all, about half of the events involve a crash. Okay, 52% of the events result into a crash. The other half actually doesn't crash within 24 hours. And we can see that average returns, of course, are much different. Okay, so for crashes, the price goes down almost to 0 after the run up, while for no crashes, it keeps going up. So there is this positive momentum. Okay, so for an investor, it would be very profitable to distinguish between crashes and non-crashes at t equals 0 after the run up, right? Because if you can select yourself into the winners, the non-crashes, then you can make quite some money by trading the NFTs. Well, if we look at the distribution of crashes and non-crashes over time, we see that there is no particular concentration in a specific week. Okay. This is what these bullet points are saying. And now let's try to make some forecasts. Okay, so let's try to see if we can actually predict whether we are into a crash or not. Okay, so again, for every event, we split the sample into these two parts. So we have the ex ante, where the price run up actually happens, and then we have the ex post after t equals 0. And we want to see what happens there. Okay, so basically we want to use some variables which are defined ex ante, so they are observable and measurable at t equals 0, and we want to see if any of these variables is actually able to make a prediction about the return of the collection in the ex post window. So we're going to use, first of all, volatility, so the standard deviation of returns in the ex ante window, then the turnover, so that's the number of sales divided by the supply of NFTs for that collection in percentage. Then we have the age, so the number of hours or days since the launch of the collection, if you want, since the publication of the smart contract. And then we have acceleration. Okay, so that's going to be an important variable. So that's the difference between the total return in the ex-ante window and the return only in the first part of the ex-ante window. Okay, so think about it. If this difference is positive and large, this means that most of the return was actually accruing during the last part of the ex-ante window. Okay, so if this difference is large and positive, there was a huge acceleration in the price close to t equals 0. Okay, while if returns were spread out across the day here, and so the price was going up, you know, very slowly, then this acceleration variable would be 0 or negative actually. All right, so if we put all these variables into a regression, and the dependent variable is the return ex ante, or actually just a dummy indicating crash events, this is what we find. Okay, so volatility is positively associated with crashes. Okay, so the probability of a crash is increasing in volatility, and it is instead decreasing in the turnover. Okay, so the higher the turnover, the less likely it is that a crash will materialize. And we also have age, but this effect is very small. And finally, we have acceleration, which is the most important variable. And the higher is the price acceleration, the higher is the probability of a crash. Okay, so let's have a look at the R squared here in this last row. Okay, so as you can see, volatility is able to explain about 5%. Then we have turnover explaining like about 2%. Age is also explaining only 2%, but the acceleration is explaining about 60% of the variation in the dependent variable. Okay, and most importantly, if we put all the variables together in the regression, we get an R squared of about 21%. Okay, so it means that we have quite some forecasting power in forecasting these dummy indicating crashes. And if I rerun this regression by changing the dependent variable to actually the returns realized in the ex-post window, I would obtain more or less the same results. Okay, so all of these variables are significant and they actually help predicting future returns. All right, so all of those variables are market-wide variables. Okay, so we don't actually need to go at the investor level in order to construct these variables, right? So we can just look at returns, we can put our volatility, look at trades, and put our turnover, etc. But now let's move into a more interesting territories. Okay, so we want to look at agent-based or agent-level variables. Okay, and to do that, we can exploit the fact that all NFT transactions are recorded on the blockchain, and for every transaction, we can see who is the buyer, who is the seller, and we can track the activity of those wallets across the entire NFT market. Okay, so we observe these unique wallet IDs of buyers and sellers, so we can track their activity and profitability across different run-up events. And we can also check their activity on other decentralized finance platforms. Okay, so the idea here is let's see that we find a wallet which is performing very well consistently across 100 run-up events. Okay, so we can see because we have the unique wallet ID of this guy. Then can we also see if this guy is using other decentralized finance applications? So is it taking leverage? Is he using decentralized exchanges? Is he lending his assets? So we want to check whether these informations about buyers and sellers may help us understanding whether the collection will crash or not in the future. Okay, so can we leverage this data to improve the ex-ante identification of bubbles? So meaning, can we forecast bubbles ex post? Okay, so we will construct 3 agent-level metrics. The first one is the percentage of so-called sophisticated investors participating in a run-up event. Okay, so we want to, first of all, we'll define who are the sophisticated investors, and then we will test whether when you see that so many sophisticated investors are participating, the probability of the following crash is higher or lower. And the second variable is the ownership concentration. Okay, so that's the number of unique owners for a given NFT collection. Okay, so if every piece of the collection is owned by a different wallet, the ownership concentration measure would be 0. And otherwise, I mean, vice versa, the other extreme is that if every NFTs in a single collection are held by the same wallet, then we say that the ownership concentration is 100%. And finally, the last variable is the amount of wash trading. Okay, so I will tell you more about that in a minute. Basically, wash trading is kind of artificially induced trading in order to inflate the real trading volume on an NFT collection. And we want to check if that's related also to the formation of bubbles and crashes. All right, so let's start from sophisticated agents. Okay, so first, we compute the profits of agents of different wallets during our run-up events. Okay, and we find that there is a lot of persistence of performance over time. Okay, so it seems like that some users, some people are doing very well, so they can make money during these price run-up events, while some other ones are consistently losing money. Okay, so there is some, I guess we can say that because we have this autocorrelation of performance over time, we can say that returns are not only driven by luck here. So there is some skill component. There are some individuals that are performing better consistently. Okay, so because of that, we think it makes sense to define this set of sophisticated agents. Okay, so we just define them as those users that perform very well in the previous events. Okay, so in particular, we require at least 25% profits averaging on the previous 5 events, 5 run-up events. Okay, so actually we find that there are about 12% of sophisticated agents in the pool of investors participating in our run-up events. Okay, so let's say that's the top 10% of the traders in these markets. Those are the sophisticated agents. So let's have a look at their characteristics. Okay, so are they different from other traders actually? Well, if we look at the NFT markets, we find that sophisticated agents trade much more. Okay, so 22 trades, I think, per day instead of 3. They also trade bigger volumes in Ethereum terms and also in dollar terms. And by definition, they make higher profits. Okay, and also they have a slightly higher holding period, averaging at 7.76 hours. So slightly higher than the non-sophisticated investors. But I think the most interesting thing is that they just trade more and they generate more volume. So they are more active in the NFT market. And then what if we look at the other transactions that they make on the blockchain outside of the NFT market? Okay, so we can see that the total number of transactions they make on the Ethereum blockchain is much higher than the other people. Okay, so we have more than 1,000 transactions per user versus 270. Also, the value attached to those transactions is higher. And also the age of the wallet is higher. Okay, so those people created their wallet before the non-sophisticated agents. And also these sophisticated guys are more likely to perform swaps on decentralized exchanges or to provide liquidity to decentralized exchanges. And they are also more likely to be involved in decentralized lending and borrowing. Okay, so it seems like those sophisticated agents that make higher profits during NFT run-ups, price run-ups, they are also the guys who are using DeFi services more, okay? And they are there from a longer period of time. So in a sense, you could call them the blockchain experts. We call them sophisticated investors. But I think it's interesting that if you start from a definition only based on the performance in the NFT market, you actually find this highly significant difference in the characteristics of sophisticated investors versus other ones. All right, so now let's move to our second variable. That's the ownership concentration. So there is not much to say about it, okay? Apart from the fact that this variable is actually displayed on OpenSea and other NFT exchanges. So apparently, people using these markets believe that it's an important indicator, and it is just defined as the number of wallets holding an NFT of a given collection, divided the number of NFTs available in that collection. Okay, so it's simple ownership concentration measure. Then let's go on and talk about wash trading. Okay, so that's just a way to artificially inflate volume by repeatedly trading tokens. So let's say, I have a friend who will help me doing this, or I just create 2 wallets. This is something that it is possible to do. And then with the first wallet, I buy an NFT, okay? And then with the second wallet, I buy it again. And then I can do the reverse transaction. So wallet 1 is buying the NFT from wallet 2, and then I do it again and again. Okay, so this creates a lot of artificial transactions, and it actually inflates the volume which is recorded on the blockchain. Okay, and some people may want to do this in order to inflate the price of an NFT collection. Because of course, more volume attracts attention. And if you can generate a lot of volume by this wash trading, then, your collection will stand out in the chart of the top collections by volume during the last hour. So most likely it's going to gain visibility, and maybe it may, attract people to trade and to buy into that collection. So it just gives the, let's say, the illusion of liquidity and of trading and of interest in that collection, while it actually is fake. There is nothing there, right?
Andrea, we have roughly 10 minutes left, so maybe you can conclude in the next 5-6 minutes, so we have some time for 2-3 more questions.
Yeah, that's perfectly fine. That was actually my plan. So I'm about to conclude here. All right, so that's a plot showing the volume on NFT exchanges in dark blue and the amount of wash trading. So you can see that there was a period of time in 2022 where wash trading was really, really a big thing. Okay. And actually, fortunately for us, most of this wash trading is not happening on OpenSea, but it's happening on different exchanges. By the way, what we do is we use an algorithm to identify wash trading transactions, okay, and we use it to see if it's a nice predictor of crashes. In particular, we use the method by Hill-Dobby. So this is based on an algorithm involving the application of 4 filters. So basically, a transaction is marked as wash trading if the buyer and seller are just the same wallet. Okay, so that's possible. Or if there is a pair of wallets buying and selling the NFT among each other, or if there is just an address that bought the same NFT 3 or more times. Okay, that's an indication of wash trading. And lastly, it could be that the buyer and seller are different, but they just have, there is a third wallet which is funding both of them. Okay, so that's an indication that those 2 wallets actually belong to the same person. Okay, so by applying this algorithm in our sample, we find that a very, very small fraction of transactions is marked as wash trading, 0.23%. Okay, and the trading volume of those transactions is actually pretty small with respect to the total. All right, so now let's use these agent-based variables to predict crashes. Okay, here it is. I will try to make it a bit bigger so you can actually read it. Okay, so in the first column, we just use these new variables, the number of sophisticated agents, the number of unique owners, and the wash trading. So we can see that if there are more sophisticated agents participating, then this reduces significantly the probability of a bubble or a crash going forward. Okay, so it seems like these sophisticated traders are actually able to self-select themselves in the good price run-ups, so those that will continue afterwards. Okay, so they're not buying into bubbles. The number of unique owners is negatively related to crashes. So if you have more unique owners, actually it's less likely that you will observe a crash. And finally, wash trading is positively related to the crash probability. Okay, so that makes sense. If you have more wash trading during the price run-up phase, then it's more likely that the price will collapse afterwards, because that was just fake volume. Okay. And then we have column 2 and 3 here, where we just have a regression with the market-wide variables we used before, and then different specification with all the variables together. So I put this here just to show that the R square increases from 21% to about 24% when we include the agent-based variables. Okay, so those seem to be pretty important as predictors. And the same basically goes if we use the ex post returns as a dependent variable. Okay, so now what is the economic magnitude? So can we use our predictive model out of sample to, decide whether we want to buy into an NFT collection or not, given that there was a price run up? Well, so to see that, we actually fit the model on the first half of event realized in 2021, and then we produce out of sample prediction for the last 50% of the sample of events. Okay, and then we track two portfolios, buying at time t = 1 and selling at time t = 24. Okay, so for predicted known crashes, we basically buy, and for predicted crashes, we sell if you want. Okay, and this is what happens. Okay, so the portfolio of predicted known crashes in green actually exhibits positive performance, while those collections for which we predict a crash are actually performing very well, very bad after t = 1. Okay, so it seems like our model is actually pretty powerful out of sample to distinguish between crashes and non-crashes ex ante. Okay, so basically we would make a profit of about 20 ethers by investing 1 in every collection if we invest in these ones where the prediction is positive, and instead we lose 133 ethers on the other ones if we would invest in them. Okay, then I will skip on this one. So the conclusions. So I think we showed that market-wide characteristics of price run-ups can help predicting ex post crashes, and the same goes for agent-based variables that can help improving the prediction. So the economic magnitude of crash predictability is large, and it increases if we use the agent-based variables. Okay, and our results are actually consistent with empirical literature on bubbles in other asset classes. And then we find that there are these sophisticated investors that can consistently outperform other investors, and they seem to have superior skills, and they use blockchain-related services more. All right, so that's it. I will stop sharing, and I open the floor for questions.
Yes, 2 questions came in. Maybe you can have a look at them. The first is from JK about security issues.
Yeah, okay. So I can imagine that a new technology which attracts many fortune seekers is also very prone to scams. Are there any observable schemes in the NFT field? Well, first of all, the biggest scam of all, if you want to call it a scam, is to create an NFT collection and then advertise it on Twitter, on Discord, on other social media, okay, to create the impression that there is a lot of hype for this NFT collection. And then, people just buy into it, and basically they pay money to the creators of the collections. And after a few days or a few hours, the price of those NFTs just goes to 0. Okay, so that's not, really a scam, meaning that people decide to buy into those NFTs because they hope that the price will go up. They just make a bad decision. The scammy part is that there may be multiple people posting messages on Discord, on Twitter, on Telegram groups, claiming that this collection has huge potentials, that the developers team behind it is very, very good, and they will do crazy things in the future where you can use those NFT tokens to gain multiple services in different platforms, etc. And maybe all of this is just, pure lies. So I think that's the most common scam in this space. Julian says, another use case of NFTs that is really talked about and goes beyond the generic art collectible use cases is token-gated commerce. Okay, so again, I don't know about this token-gated commerce, so sorry, Julian, but I cannot comment on that. And there is a question by Sandro. Have you used the model for your own trading purposes? If yes, what was your return? Well, unfortunately, Sandro, I didn't use the model because, you know, it's actually pretty difficult to use it live. Because, you know, right now we have historical data on a bunch of NFT collections, and the model is set up in that way. So it is trained on part of the data, and then it is tested on the second part of the data. That's pretty easy to do. If you want to do it live, you know, you need to write some code that would allow you to download the relevant data from the blockchain live. Okay, and then you should run the algorithm live to output the predictions, and then depending on the prediction, your script should you know, use Web3 technology to connect to the smart contract of the collection and to buy a piece of the collection. So unfortunately, you know, I have other things to do. I have to teach, I have to do research, so I didn't have the time to implement this. But if you have the time and you're willing to do it, please let me know if it works out of sample.
Thank you very much. Is there one or two more questions you would like to ask Andrea? Does not seem the case. So that's very punctual finish. Thank you very much, Andrea, for this very interesting presentation. I'm not sure I understood everything, but you seem like a very smart person. Was very interesting. I think I have to look at it again. You'll provide us with your documentation, if that's okay for you. I will send it to the participants. Thank you, dear alumni, for joining us. I hope you enjoyed it, learned something also about NFT markets and how the price bubbles come across, and would love to see you at one of our next following sessions regarding Web3. I posted the link in the comment section. Next week we have several sessions, so hopefully I see some of you again, and wish you all the best and see you soon. Thank you and bye-bye.
Thank you, Sasha, and thank you everybody for your attention. Have a good day.